Our guest this week is Eric Golden, founder of Canopy Capital and host of the Making Markets podcast. Eric was a portfolio manager and intrapreneur at Fidelity prior to setting up Canopy, so he has great perspective on both markets and life as a venture-backed founder. We talked about those experiences, his current view on markets and Web3, and how his view of venture capital has evolved over time. It was a really fun discussion. Please enjoy. Eric, thanks for coming on the show.
Thanks for having me, Joe.
We've had some fun chats in real life. I'm also a regular listener of your podcast, Making Markets, which is great. It's really interesting, nerdy, but you keep it accessible. So I really enjoy the show. So this should be a fun conversation.
Thank you. It's a lot of fun. I'm happy to be on the other side now.
Cool. So maybe to get things rolling, can you tell folks about Canopy Capital and the show?
Sure. So Canopy Capital is a startup asset management technology platform for advisors building separately managed accounts focused on tax-individualized investing. And my belief is that I was in the fixed income industry. Now I've been in it for almost 2 decades. And we went through a shift across all of asset management, but fixed income has been delayed in this, which was we moved from high cost alpha products, the years of, Peter Lynch trouncing the market, to lower cost passive products. And that had been a big trend. But another mega trend that was developing that had always been a key part of ultra high net worth was customization and tax optimization. Essentially finding a way to say, whether you want active or passive exposure, are there vehicles or strategies that on an after-tax basis would perform better than just pure gross performance? And the reason why I think it's been slow globally is that the entire financial services industry is essentially practice off of gross returns, starting with the mutual funds, which were the behemoth. You're paid to beat a benchmark. And the idea was, well, there's all these different shareholders. They have different tax situations. What do we know about all funds? If we assume gross returns before taxes, before fees, we can compare, and then we can do net performance with the fees, and we can say, how do we compare and contrast these two? After-tax performance would be really hard to calculate on every individual's tax rate. Even though it's hard, it doesn't mean it's not exactly the right thing to do. And I think my career has been focused around what's the right way to do it, and I don't care how hard it is. And there's usually an intersection there that sometimes the right thing to do is absolutely brutally hard, but there's been a lot of value in trying to solve it and doing it the right way, knowing that that's what the customer wants. And so for me, I always had an entrepreneurial bent. I always started companies. I love the idea of just solving problems and there being a reward function related to it. And so I've just been obsessed with this idea of what is the best way to construct a portfolio on an after-tax basis. And that means that if you've got a 0% tax rate to whatever the highest now is with all the, north of 50%, that there's a right portfolio for you. And I want to be able to build it specifically for the individual, which we've coined tax-individualized investing. So that's what Canopy is building, and I'm sure we'll jump into it. The show was really something I didn't want to do. I thought there was too many podcasts in the world, and that wasn't something. Patrick O'Shaughnessy's Invest Like the Best was one of my favorite podcasts, and Patrick asked me to originally just cover crypto in 21, which was fun because I'd always had a passion for crypto and loved it and thought it was an interesting space I wanted to learn more about. And as you know from running a podcast, it's basically a selfish excuse to get to talk to people and learn, which is super fun.
Yes, it's great.
Yeah, so it's great for the host. Hopefully the listeners get to enjoy stuff too, but it started off with that. And then for me, we can get into crypto deeper too, but crypto was interesting to me because during my time managing, fixed income assets in early 2000, when it first came around, it was presented and I was like, this is ridiculous. I brushed it off. I was a big believer that the dollar backed by the world's greatest army is the currency and you're not going to replace it. And as a currency, I missed the understanding of it. And all I really needed to do because of my background was had I read the white paper, and if you understand relational databases and how data can be stored, you quickly go, oh, this makes a lot of sense without all the hype. And so I found that in crypto, a lot of people ended up being right for the wrong reasons. It doesn't matter. But when it got to me, I started to think, okay, if this is when the narrative changed to it's a consider it like an asset, like a store of wealth, like digital gold, that's when I got interested in it. And I was dealing with a lot of traditional investors who were just very dismissive. This is ridiculous, Eric. This is foolish. This is for all these bad things. And not that there wasn't full of scams, and crypto can be used for nefarious things, just like the US dollar can be used for nefarious things. It just had a big taint around it. And my view is like, look, it's an asset class and people trade things, and I see it no different so as other asset classes. And so you don't have asset classes just born that often, but I saw no difference. And how that relates to the podcast was markets or trading and risk are all the same. And what I mean by that is I've had wonderful conversations with people that trade thoroughbred horses, vineyards, from the grapes themselves to the wine to the land it's on, watches, rare art, photography, how that's different than art. And when you get into it, the people that actually take risk with capital as an investor, if they're doing it at a professional level, they all have very similar thought processes. They think about their portfolio allocation. They think about liquidity. They think about sizing. They think about risk. They think about supply, demand. They think about income and challenges. And so I just love the fact that it's really, to me, a universal language. And if you view markets like that, it's one of the most amazing places because you're constantly learning, but then you drop a lot of biases. Whether you're trading tickers or CUSIPs or tokens or watches or tickets, they're all just instruments that someone's valuing and another person may need, and that there's a tremendous amount of liquidity and market structure that looks a lot like the world that we grew up in. And so I just loved it. So we started to add other asset classes, investment types, which has just been a blast. And following that same narrative that I've always believed that markets are just markets and free markets are great for pricing assets. And the more esoteric the asset, kind of the more fun it is to try to dig and learn. I think the hardest thing has been that there's so much alpha in the esoteric assets. A lot of the conversations we can't publish, or people want to talk, but they don't want to be recorded. But it's been an absolute blast. And so the show's been a lot of fun.
I want to come back later to the right for the wrong reasons as far as your views with venture.
Yeah.
Because I think that's a good one to unpack. But on the topic of guests, I guess two things there. Guests coming on the show to talk about generating alpha, and also the most interesting markets to you. I mean, some of the ones you mentioned were the most interesting to me as a listener, but what do you, as a listener, I'll hear people come on and they're talking about these relatively niche markets. You would think there's not much. And sometimes these are firms that they're already full up on capital. Mm-hmm. They have a wait list sometimes. And I listen and wonder, what do they get out of coming on to this show and telling the world about the finer points of their strategy and how they're able to generate all this alpha?
Yeah, no, it's a great point. It's a horribly designed show from that way. Like the best way to create a podcast, there's like definitely ways to hack it, which I don't like, is, just interview people that are launching books that have ways to generate money. And a good friend who runs a very successful podcast explained to me, like, look, this is just a transaction. They want your audience and they want to sell something and you want content. And I hate that. And so for me, I don't, you have to ask some of the guests, I think. And that's why when I ask people, I always feel like I'm asking a favor for them to do it. I'm grateful that they do it. It's probably the hardest part. Like, some people love podcasts because it gives them a platform to get in front of people that want to get in front of larger audiences. So there's a symbiotic relationship. I'm kind of a messed up and probably a poorly designed show in that way, that I'm usually like saying, could you please talk about this? I think it'd be really interesting. And they agree. A lot of people, had to be, to your point, if your hedge fund has a lockup and there's no more money coming in, do you really want to talk about it? I agree. I think that one of the ways I handle specifically the alpha part, not necessarily the why, which is a little bit harder to answer beyond asking for a favor of people in your network, is it's fun sometimes to talk about edges that went away. I did this when we started talking about high frequency trading, which is something I've always been fascinated with on the equity and fixed income side in particular, because it's been a huge part of my career and success has been learning about some of the high frequency trading that happens across public securities. And great traders it's a curiosity hunting game. So they're not going to tell you like, oh, how am I making money today? Like, what's my favorite trade? But they have great stories of things they did in the past that demonstrate their innovative thought process, how they think about things. And I think people sometimes enjoy sharing that. Maybe it's driven by ego, but I don't think that's always the case. I think it's that a reminder to stay fresh, and that if you think you might not be able to share today, but any great investor knows whatever's working today will be gone tomorrow. So it's very fleeting. And so you're constantly trying to stay sharp and find the next thing, and probably demonstrate to the world that that's the type of thinker you are. And if that's the case, then I think people, generally like sharing that type of information. Like I remember in the early 2000s when I learned about storing private jet data. Did you do this?
I did not, but I remember it being a thing.
Yeah. So like I was focused on a specific strategy where we would be able to benefit from M&A transactions. And you're trying to scour information of who's going to buy who. Well, one of the best ways was that there's publicly available data on the tails of private jets. And so just, this isn't investment advice, this isn't what I do or have done, but I'm saying, like, just as a hypothetical example, if there was a company located in upstate New York that was, where IBM's headquarters were, and there's a bunch of private jets going to Kansas City back and forth out of that are unusual, you might think that there's something going on. Now, it might just be pitching. It might be the executive's family is having a health issue, but it was a good way to say, is there some other angle that could be part of my mosaic theory for why I think, this action may happen? And I just love that stuff. I thought it was so cool that people would scour data sources and find ways to tilt the scale. And what's the greatest game in the world is investing. And it's the hardest, most brutal thing, because you're constantly reminded you're an absolute beginner fool and you know absolutely nothing. And you just try to get a little bit smarter and hope to you're going in the right direction. And it's infuriating, for people that go to school, for the younger people that like listen to the show, they're in the top schools and they're focused on grades, and there's a game with a winning proposition. What was my score? In investing, you can say it's money, which over the long term, okay, maybe I win, but this gets to that point of I've seen really stupid people make tremendous amounts of money, and I've seen absolutely brilliant people have breakdowns, lose everything, and lose their jobs. And it's completely unfair. And that's what the markets will do. It's not just this person's the smartest, best, has the best process, the best risk tolerance. There's all sorts of things that can blow you up. So if you navigate that, for most people, that's very unsettling. It's not a math problem with a proof and who did it right and who did it wrong and who did it the best way. It's brutal, and that attracts all sorts of people, very driven people, very smart people, to play what I think is the world's greatest game.
So on games, competition, if you had to force rank the major asset classes, and let's say there are public equities, fixed income, and fixed income's a big 10, but we'll just say fixed income broadly, private equity, venture, and probably there's commodities. I don't do anything with them, so I'm not really interested. But let's just say those four.
Yeah.
If you had to force rank those on competitiveness for generating alpha, what would you say are the toughest, and what's the lower hanging fruit?
So my views on this have changed. So I think when I was young and coming out of school, I basically just looked at the efficient frontier of risk and said the lower volatility asset classes are the easiest to get into, so they're not the smartest people. And then the highest volatility, those must be the smartest and must be the hardest. So I had a very naive view. So I'd say, okay, on one side, I started in muni bonds. I was at the lowest possible level of like risk taking. So I must be in like the worst cohort. And that was, I didn't go to an Ivy League school. I broke in, like my story of getting in is crazy, but I finally made it. But we were like the lowest person on this totem pole, and I made up in my head. And then, corporate credit was more impressive than that. And then public equities was more impressive than that. And then private equity was more impressive than that. And venture capital was more impressive than that. And then you had this funnel of the risk that they were taking and the limited amount of seats, which could also correlate to compensation. I associated that with intelligence and skill. And that over, my career has been proven very wrong. So I'll biasly say that I honestly think the areas that I'm most impressed of someone's background is less to do with the asset class and more to do with the type and style of diligence they do. So the reason why I think municipal bonds, where I started, is the best, maybe not the best, I'd say it is one of the best. The other one I would put up there is high yield credit, distressed restructuring, private equity origination, at like actual full buyout. And all of those have one thing inconsistent, which is not volatility. It's reading and understanding documents. and it's having to spread numbers and financials and legals on your own. There are no crutches to look at. There's no system that does this for you. If you invest in a municipal bond, although the credit quality is very high and the risk is very low, it's all true. It's a 300 to 400 page document that is unique and distinct from every other issue that issuer has issued. It's not an off-the-shelf registration like a corporate credit is, right? So if Apple issues debt, they have an SEC document that's called a shelf registration that Bloomberg will map you the covenants. If you meet a corporate credit analyst, ask them if they've ever read the covenants. Read, meaning, have you read the legal covenants? Yes or no? The answer is no, because there's a system that was created around it to normalize it and serious. So there's no edge in reading legals, nor does anyone really have to, because Bloomberg pulls it up and the whole market knows it. It's knowable. On the muni bond side, you have to read it. And if there's disconnects between documents, that means that if you look at a bond, if you look at it was very obvious in the distress of Detroit and Puerto Rico. But even if you look at, single A rated hospital debt, the bonds are going to trade in the market the same because people are going to say this is all the same thing. But literally the security package could be different, giving you a better position, which is of value to a sharp and shrewd investor, which can really help in things like an M&A transaction. And so if you actually are trained to read documents, there's a tremendous bedrock skill that you understand something, and this is just a theme of getting to the root understanding of how something works that then you build on top of. And one of the problems is, which isn't really the fault, that if you come in as a corporate credit analyst, you've got such a foundation, no one ever had to go to the root level. So maybe in the 70s, before Bloomberg and FactSet and all these things that you can buy, you had those skills. But then when you have technology that does it, you just become used to looking at the screen and not asking questions from a sense of a first principle of how does this actually work. The same thing happens in high yield. There's debt restructuring, that you actually have to open up documents and understand how bonds work in order to make money. In private equity, when you're buying a company, it's both the valuation as well as the legal structure. So for me, I had the wrong perception that risk taking was where there's definitely something of it's more competitive to answer your competitive question. It's more competitive. I had the competitive ranking right, and that was apparent based on how hard it was to get the jobs. But of skills, I'm always interested in people that have gotten foundational, which is why banking, when I was coming out of college, was so valued, because it was a foundational skill level. You went to this boot camp, you were basically like a resident at a hospital, and you were forced to see so much that the idea that someone that went through a rigorous banking program for 3 to 4 years just had general value for their career was because they've had to brutally do stuff that the other investors are on top of. So back to my point of foundation, it was the bankers that were building the foundation, selling it to the buy side, who's like, I don't have time to do this, and then trying to make a higher level decision. It's not that the higher level decision and the abstraction isn't of value. It's just, to me, if you have never done the math of a bond OAS calculation, if you've never built the financial model from GAAP statements yourself and forced yourself to understand how the business works, you're not going to be as powerful when you get to the abstraction layer because you don't understand it at its root level.
I've listened to plenty of interviews with VCs over time, and a surprising number when they talk about their origin story of getting into venture, it begins with, well, I grew up on Sand Hill Road, or my dad worked in venture. I was a founder that had a very big exit and someone invited me to work at their firm. The percentage of ones that are, well, I just hustled really hard, got in as associate, worked my way up. It's the minority on those. And so I guess to your point on competition, it's been interesting for me coming from a public market perspective where edge is so incredibly difficult to come by because everyone's essentially working with the same information. So your edge is, do I have more permanent capital base? Do I have an analytical edge? And from an information edge standpoint in public markets, awfully hard to come by. I think you're almost deluding yourself if you think you have one, or at least you might find one, but it's very, very fleeting. And sure, you could point to Renaissance is a counter to that, but obviously their success is a pretty big aberration. But if you look at venture, like something I did just to help frame going into venture, the level of competitiveness, I looked at the number of deals that happen in a year and the number of venture funds there are relative to number of US mutual and hedge funds. And I looked at the number of listed securities. And essentially, there's 17x the number of competing funds per deal or investment opportunity in public markets than there is in venture.
Mhm.
There's a lot less competition fighting over the same number of deals, and half your competitors don't have investment backgrounds. They're operators, which has its strengths, to be sure. I can already hear some people throwing fruit at me. But your point on kind of doing the work and getting into the minutia, some of that comes from being a career investor or just getting ground in fundamentals.
I think it depends on venture. For me, it was a little bit that I had such high expectations. I was let down after starting to interact with venture capitalists. I thought they were the greatest investors, but that was my own naive. There was no one I grew up with. I never met a venture capitalist until after college. It just wasn't something in my life. So I just had this, oh my God, they must be brilliant type folks. And then I was a bit let down. Now there are some great venture capitalists. And I think if you dive into venture capital, you've got different segments, right? So you've got the seed and the series A's, these BCs. So there's evolutions of where you are in the company. And when you get into growth equity, now you're getting to this crossover private equity public. So I think it has a lot of the same flavors of growing up like on the public market side. On the early stage stuff, I think that what's so challenging is that capital is easy to come by. Like if you think about venture originally, it was great idea, doesn't have money finds great idea and sets people off. But like anything, markets are great, they evolve. I think that the market for private equity and venture capital, not to upset any of my friends, is like massively overpriced for the value being delivered. There are some great firms and it's worth it if you can get into them. But by and large, the fees that are being charged for the return profile is not appropriate. And eventually, not just the competition amongst them, but that will come down. It will normalize that the fee structure isn't so high that and that is where you have a tremendous amount of easy capital to get access to. The tricky part is the repeatable investment process of finding great companies and having something that differentiates. And you're talking about a game that at the human level gets down to like, if you asked me if I invested in venture, what would I want? I'd want to talk to someone about like what their life was before they were 14 years old and figure out their like core motivations and understand them as a person. And how many people can I really do that with and get time with and understand them to then once I know them, know that, okay, based on their wiring and the problem that they're going after, I believe that these two are both right. So not only do they have the right idea and the right problem, but they have the right wiring as a founder to push through. That's a hard game to play. And it's a hard game to repeat, and it's a hard game to scale. So it doesn't mean that you can't find one or two and they can be this, the lottery ticket like structure that is needed to, return the whole fund. But it's a brutally hard game that's not based on understanding documents. That's not based on spreading financials. It might be not that investing has any hard science to it. It's not like physics, which I hold the highest regard, but there are definitely skills that one can develop to get better at it. In venture capital, especially in the early stages, so much of it is about your relationships, your networks, your ability to get involved in deals, and there's a negative selection bias. Why is the deal coming to you? You know what I mean? There are people that raise money that don't do roadshows, that don't do pitch decks, that don't have to because they have a network of people and people have already found that person and they know what they're doing. There's other people that are like, do you want to give money? I'm raising, and you're seeing a negative selection bias of what deal comes to you. So it's a really, so like from a competitive standpoint, I don't necessarily agree of like, well, venture capitalists to deals, like the number ratio versus like hedge funds to public securities. I think it's a completely different, in my analogy of everything's a game, it's a completely different game than the public side.
Well, an interesting thing with venture is you've got fairly high persistence of top performing funds, but a counter to that is that when you look at fund performance over time, there is a clear drop from fund ones on average are better performing than fund twos and so on. So a quirky thing with venture is really common narrative is network, referrals, deal flow, all from brand strength that you get and connections over time. And yet a typical fund 3 or 4 from the same shop from their relative to their fund one is very commonly with worse performance. And you would think it's a little counterintuitive, but scale is probably the biggest pushback to that makes it hard to put more capital behind. Perhaps being a little fat and happy if you hit a unicorn or two on fund one. Okay, I want to ask about your experience as a founder. So you were at Fidelity for 17 years. You were an intrapreneur there. It's a long time. You know, you're a corporate guy. I'm sure you thought for a long time you might be a lifer there. Now you've gone off, you're an entrepreneur. How have you found the experience of building a venture-backed company on your own versus, building something and the feeling of building something, but doing it within a much bigger organization?
They're both brutally hard. One gets more, credit because if you build a company inside a company, everyone can always say, well, it only was successful because you were at a big company, right? Fidelity is one of the greatest distribution of financial products in the world. You would argue, well, that any product you launch should become the most successful thing. Now, history would tell you that the company's launched a lot of products and not everything was nearly as successful as what I built there, but it doesn't matter. The credit you're going to get is always going to be underwhelmed by that part. So that's one thing for people. And so that's just a shout out to all the people trying to build stuff in big companies. The second thing is, so people think it's a lot easier than it is. The second thing is the internal frictions of building in a big company are a lot harder than most people, than a founder on the outside would think of. And it's a trade-off because it's a traditional innovator's dilemma. If you're at a big successful company, it has, rightfully so, this isn't with judgment. It literally is how I've always thought that the company as like a human organism is going to reject risk taking because it's protecting its core functionality. So this is what, the most recent thing with the founder mode stuff is kind of, in my opinion, what it's getting at is that the founder can tear apart their company, can shred it, can change directions, can say, this is the direction I want to go. But over time, if you work at a really successful company, I love Fidelity. I think it's one of the most successful companies ever. It would be my dream. Like, that is ideal. If you want to build a company in a sector, it should be studied, and it's hard to because it's private and people don't know about it, but it's amazing. And it's so amazing that it's a big risk to say, oh, let's go try to do something different. Let's do this. Let's do that. That's a hard thing. And that's for any big company because it's so successful. So you have this problem of the large companies are constantly trying to find innovation while the small companies can innovate but need to find distribution. And this is the constant race between the two of, can you innovate? Can you distribute? So it was the greatest opportunity of my life to work there. I never thought I would stay that long. I always thought I'd start my own company, but I kept getting better and more amazing opportunities. I love the people I work with. I knew how lucky I was. And my dad, who had a successful career in nuclear engineering, nothing to do with finance, he had managed lots of people. And he said, when someone leaves, they give you these stories. They're very personal. This is why I'm deciding to go. And, sometimes it's not necessarily being truthful, but it's also hard for them to share exactly how they're going, especially if they've had a long career and they feel emotionally attached. So if, like me, Fidelity was my family. So leaving was the hardest decision I've ever made. And it's something, it's hard to explain unless you've gone through it and felt that way. Some people hate their company, so when they leave, they're like, screw that place. But I loved it. I started when I was 19 years old as an intern in college. Like, it was just where I was my whole life. And my dad's advice was that after hearing hundreds of people retire, quit, resign, change jobs, he would just say, look, there's two reasons why you're leaving. You're either pushed by the company or pulled by something else. If you're pulled by something else, I fully support you and I'm happy. But if somehow you're being pushed as part of that equation and the company did something, that's what I want to know about to try to make it better. And that's the truth. And for me, this has been pulling at me my whole life. My managers knew it. The leadership knew it. Everyone knew that I wanted to run the company or start my own company. And those are pretty ambitious goals, that I either wanted to run Fidelity someday or start my own. And it came down to my final decision was reading the Bezos regret minimization paper about when you're 80 and you're on your deathbed, will you look back on it and have regrets? And it took 2 years to process and talk, and I'm lucky to have a lot of people in my life to say that if I never tried this, if I never tried to build the company and have the opportunity to lead an amazing team, I think when I died, even though it's hard to justify you could ever make more money than working at Fidelity because it's such a great place, and I had one of the rare jobs of being a portfolio manager and managing director at Fidelity, that I look back on my life and I have regret, and I just couldn't do that. And so starting a company has been the most brutalizing, hard thing I've ever done. It definitely attracts a personality type that wants that type of stuff. So there's a personality, either trait or defect, that you actually like that. And I think one thing that was interesting about the transition from intrapreneur to entrepreneur was that when I started, Ned Johnson ran the company, and he would give these speeches and talk about how we were owners of Fidelity. I always felt like I owned it. So when I started the business, even though I had no ownership in it, I treated it like it was my own. I didn't sleep. I traded. When my daughter was born, I did 186 treasury trades from labor and delivery to make sure the business would open the next day. It was brutal. I didn't sleep. When a problem would happen, I couldn't eat. I was sick. I took it as my own, and it isn't. And that was a hard thing to mentally deal with, that I was acting, I was suffering all of the stress and the pain, but it wasn't my own. I didn't have full autonomy to do those things. And starting, it's kind of that someone asked me, I was just with someone who has a very successful career, and I give a lot of advice. And most of the time I tell people to stay at typically the big firm they're at. And I tell them, like, you don't understand. You might be upset. You might have a bad boss. The grass is always greener. You're getting paid a lot of money now with, like, you're working 3 days a week. Like, enjoy your life. And when you're ready, if you're pulled by something, then go do it. But he was asking about my transition, and I said, from a work standpoint, I was acting like this. There was other stuff on my plate that I was dealing with. That's big corporate America stuff that everyone struggles and deals with. But I was already acting like this. And so it wasn't that different. The big difference was that I was asked, what are you solving for? Power, money, or fame? And I thought about that for like a bunch, and I didn't have an answer. I definitely didn't want fame. Money and power are probably the ones that I was ranked them. I said, if it really comes down to it, the thing that I'm trying to do is I want to work with people I absolutely love working with on a challenging and hard problem that if we solve it, there's economic benefit, such that the economic benefit lets me stay in control to keep working with the best people in the world. That's my perpetual motion machine, is working with brilliant people on a really hard problem. And if we win, those great people stay because they're financially rewarded, and we can hire great people. That to me is the definition of a successful business. And we just started. Everything's so early. You go back and forth like any founder with, this is the best idea I've had. This is the absolute worst idea I've ever had. What am I doing? But a lot of days you look at it, and I'm working with the absolutely brilliant and amazing people on a problem that I'm convinced is hard to solve, and that everyone knows it. And I think that we know how to solve it differently than people have approached it before. And when I ran the numbers and talked to investors and venture capitalists, people were like, yeah, if that's right, and you believe this and this, then yeah, this will pay off. So I think we're on that path, and that's how I deal with it and sleep at night. But it's not an easy decision. I think it's, like I said, it's the hardest decision I've ever made personally. And that's coming from a good place, that I had a great job, that I love the people I work with. I wasn't angry or saying, oh man. It was that if I die and I never try this, I'm going to regret it, and I can't live with that regret.
You packed a lot of insight into that one answer. I want to take it different direction. I feel like I'd be leaving a lot on the table to not talk about markets and the Fed with you. We're going back into an easing cycle. It's been a while. The Fed historically has a bad history of driving, looking in the rear view. Mm-hmm. Do you think they were late to cut rates?
I think that they were actually probably early and didn't even need to cut rates. I think that they could have cut a quarter or even waited. They would have upset the market, but the market's not what the Fed's mandate is. I think that inflation's come down. Unemployment is not spiking. Maybe we've turned. And I think that it's a question of, I probably think it was too early and potentially too much. And because of that, you want to get long risk, because if I'm right, then the easing is going to lead to more easing, which is going to lead to another melt up. So there's my personal view, which doesn't matter because I'm not the chairman, and it doesn't really matter. My job is to observe it and then position accordingly. So I think that the Fed is the whipping post of the market, that if you lose money, if you don't like what's going on, you blame the Fed. Every recession's been caused by the Fed. The Fed was too early. The Fed was too late. The Fed left the punch bowl. The markets are constantly sharing and deciding the price of risk. The Fed isn't forcing you to buy high yield distressed credit. It's not forcing you to buy AI companies at high multiples. You're doing that because of animal spirits and your desire to outperform the market. The Fed isn't causing rates are low. Did people just start borrowing in mass? No, people did financially prudent things. They refinanced their largest leverage, which was their home. Did corporations take advantage of it? Yep, they levered up. They bought their equity back, but we didn't cause a credit crisis. And what we've had is I'm forgetting one of our guests, what's his name? Elliott Funds, Bob. He calls it an income driven cycle. And the thing that's interesting about that is that people are very focused on credit cycles. So if you study the history of finance, one of the best ways to know what's going wrong, again, why do I think fixed income as a background, at least, or some understanding is important for equity investors, for venture capital, is that usually disaster starts somewhere in credit. And what I mean by that is leverage finds a way into the system, someone becomes over leveraged, and then the unwind happens way faster than the levering cycle because everyone freaks out and then everyone starts figuring out where's my risk, and you have a crash. So if you look at a lot of crises, credit, the tequila crisis, the Russian crisis, long-term capital management, great financial crisis in 2008, there's always credit. Is that ground zero? Find where the credit is, find where the inappropriate leverage is, and then think about the second order effects. That is a great place to always be on edge of, and I think about all the time. But this time, we didn't have a credit driven, aside from corporations or retail. We had the government levering up and borrowing, but they were stimulating the economy, and they were giving, which then drove income and wages up. So people had more money to spend and started spending it. And so we had an income-driven rally, and so we don't have necessarily a credit crisis. So lowering rates, I don't even know how much it will necessarily do to borrowing. I'll be interested to see if borrowing goes up. It's more of a directional tell to the market that now we're in an easing cycle, so people are going to take more risk. They're programmed that easing means higher asset prices, even though you're supposed to be easing into a slowing economy and potentially prevent a recession. We're going to have recessions. Recessions aren't preventable, but right now we're in an asset class trading cycle where the Fed is easing. China just decided to come over the top and ease even more. So now we're in a race of inflation of asset prices again. So, it's not my investment advice, but in a cycle of an easing moment, you'd want to be long risk because that's what everyone's trying to get on sides of, because there's $6.5 trillion sitting in money market funds and people want to know where to be exposed to risk.
What do armchair economists get wrong about the Fed and interest rates most often?
I think armchair economists, mostly, this gets back to why my podcast is called Making Markets. If you talk about the economy, if you have beautiful charts, you can wax and wane poetically, you can study stuff and post on Twitter. If you don't put capital at risk, I don't care. It just doesn't matter. It's never mattered to me. It's just not something I pay a lot of attention to. I read all the stuff that other people do, but I don't weight it in my mental framework too heavily, just because nobody knows what's going to happen. And if you knew what was going to happen, you'd be managing risk and committing capital in that direction. Just saying, what sells really well is doomer papers. The government's going to default. There's too much debt. Inflation's going to blow up. And people love reading, bearish headlines more than ever. I'll give credit to Mark Dow because I feel like he's been consistent on this. What if the headline was the Fed got it right? No one wants to write that. You can't write that. What you got to say, the Fed was too early. They were too late. The economy's going to blow up. Listen to my newsletter for tomorrow for how to save your life. Nobody wants to say everything was fine and it worked out pretty well. And here we are, because that's just not a safe narrative. Because if it is, well, why did you keep your money and not perform? And so the Fed is telegraphing its move. The only thing I would say right now, the risk to the market is that from a practitioner standpoint, not an armchair economist, and this is why I care more about the markets than I do about the economic paper, is that the market's anticipating probably has set itself up for a more aggressive easing cycle than maybe the Fed's ready for. Maybe the Fed will match it where it is, but the Fed said, not only are we going to cut 50, so there's two ways that go into this Fed meeting people thought they were going to respond. One was 25 with a really big message, like, just so you know, this is the beginning, we're not done. The other was 50 without much of a message. This was 50 plus the message, meaning we cut 50 plus we're going to do more. The market, that's what it wanted, it's what it got, but maybe the market ran ahead of itself, so maybe it fails to meet expectations. But I find that far more interesting looking at probabilities and market data than listening to someone wax and wane on Twitter.
I want to ask you about Web3 just to wrap things up. But before we do, I want to go back to something you said about observing and second order effects. And you said it in different parts of some comments there. But are you generally an investor who's focused on observing what's happening and positioning around that, or trying to predict what's coming around the corner and working from that?
I mean, I don't know if I think about them so differently. There's no way that you can't be thinking about the future. But I think what you have to observe from the market is, what does the market think is going to happen? And then what do I think those probabilities are? And then which side do I want to be on relative to what could happen? Which is a little bit different than, I think AI is going to take over the world. Okay, I think AI is going to be important too, but what's the right exposure to invest? Okay, you think no one else has thought about that? You think you're the first person to think about data centers and electricity? Like, there's a lot of people that were positioned way earlier than you. So one of the hardest parts is that as a kid, watching the markets, when I was young, I told my dad that, and my grandfather, who was an investor, that this is just legalized gambling. And this is what I mean. My framework was just risk and risk taking. And I said, you're just gambling. This is just fancy gambling. And I said, no. Read these books. So you go and read the books, and you read Security Analysis, The Intelligent Investor. And I'm like, well, now I'm a value investor. Look, there's an answer. This is the right way to do stuff. And you're like, oh, that doesn't work. And then you move on to it. You go, I'm going to do momentum, because really it's computers now. And you go through these phases. Almost every investor has read these books and kind of gone through this evolution. And the reason why I said it was gambling is because as a kid, my dad, you always idolize your parents, or many do. And he's smartest guy I know. He's talking about the internet and semiconductors and routers and chips. I don't know anything, but he's an engineer. And he didn't do well during that phase. I'm like, well, you understood the tech. You understand how it works. That doesn't matter, because the market has, not only do you have to be right, you have to be right about what the market doesn't understand. The market knows that too. The market's anticipating some level of AI and some level of data center and some level of energy. And those things are in the market. So it's not only do you have to get the earnings right or understand the growth or the future path, you then have to understand where are you different from the market. And I think what people get wrong at times is well, I knew this was going to be impactful. Okay, well, how and when and what's the market anticipating of that? And can the expectations of whatever investment you're making match that, or are you on the wrong side of it? And when you construct a portfolio, it gets to a higher level of putting a basket of risks together that you think makes sense to weather the risk profile and the objectives you have. If it's your own personal money and you don't care and you want to YOLO something, knock yourself out. But if you're managing money under an investment mandate, you have to stay within the lines. So you have to think about, okay, what are the lines and how do I think about these offsetting risks from one another to construct an appropriate portfolio, it's fun. There's no answer. There's no truth until the game's over and you look back on it in hindsight and say, how did I do? And even that is questionable of, did I take too much risk or too little risk, or was it luck? And the separation of skill and luck it can be maddening. And so it's just a constant humbling pursuit of, is there any way to refine my process to get better at this, to build better portfolios for whoever you're managing them for?
All right, we'll wrap up talking Web3. I know it's not what you're focused on day to day, but obviously you've had an interest in it. High level, where's your head at with the space?
So I was so excited because I really do believe that there are a tremendous amount of business models that could benefit from connecting where I started. There are problems that I want to solve that corporations seem to struggle with, and that connecting people, the example would be in music, that I don't like how the music industry is structured. There are artists, there are fans, it's a simplest model of Kevin Kelly's 1,000 True Fans. So how do I get Taylor Swift's fans, her fans in the front row? Because they deserve to be there, and that would be a better experience for everyone, and it would be a better economic output for everyone. One great way to do that would be having on-chain records, being able to prove and track and understand people. So I loved the idea of it. Once I got in the technology side of it, I started to learn some of the failings. An example of this would be when NFTs started trading, I absolutely loved the idea of the artist royalties. It was something that I was like, this is a better solution for the art market than an artist selling their art, making $10,000. And then, 10 years later, 2 hedge fund billionaires buying it for 100 million and the artist getting zero of that money. I love the idea that if a hedge fund billionaire bought a piece of art for $100 million, that artist or the artist's family got a royalty for life. I thought that was just awesome. And I still think it's a great business model. But there's a technology flaw in that while they were doing that, that part of the transaction was being handled off chain. And it was actually Sergio, who is Sergio, it goes by Sergio online. Sergio, who was a trader, who went to Web3, who was at Firebox. He's a great NFT trader. You should all follow him. But we had this argument, and he's like, Eric, it's not legally required per the documents, like a good analyst would. It's not technically structured with the code as law. This will be destroyed. And I was so like, I hope you're not right. And he was 100% right. They destroyed the royalty method. It went away, and I lost a lot of desire because the problem that I was most interested in had been destroyed, and it went to a capital markets, which is fine. But now I'm starting to look at the example I'd say is like, do we need this technology? It was never just use a tech for the tech. It was, is it solving a problem in a unique way? I hope we get there. I think what's great about crashes, which happen in every frontier tech, is it gets rid of the grifters and people are building stuff and they want to solve stuff. And there are real problems that it can solve. Crypto in general, Bitcoin as an asset class, if we're going to be in another easing cycle where the world's countries are going to devalue their currencies, then yeah, I think people are going to want to know a little bit more about Bitcoin. The NFT Web3 piece, I think, will take time for people to introduce technological solutions that are solving problems, as opposed to what it was a hype cycle with technology and money in search of a problem. What can we use this for? As opposed to, here's a real interesting problem. How do we actually solve it at scale?
Well, Eric, this has been a really fun conversation, pretty wide ranging. Loved it. Thanks so much for coming on the show.
Yeah, thanks for having me.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.